Hello and welcome to Forex Academy and to today's daily education. I'm your host, Robert Blackwell. I have the pleasure to walk you through today's daily educational video. Before we do so, please consult the following disclaimer. There is, of course, risk inherent when trading the financial markets. On the content of today's particular education, we will be discussing scaling in, how to maximize profits when you have caught a trend and are performing in the markets. So first and foremost, the ability to scale into profitable positions allows the trader to gain more exposure to a performing trade with the aim of maximizing profits. So if you've, for example, purchased a market, you're long in the market and the market is performing well, i.e. moving up in your direction, should you look to simply take that profit straight away? Or should you perhaps look at the technical setup and look to gain some more exposure to that market to actually look to take another long position in the same market itself? If the market continues to move forward then with your analysis, then of course you're aiming to maximize the profit from a particular opportunity from the one trade. One thing I would like to point out in terms of scaling in, it is a skill choosing optimal entry prices and an accurate notional trade size across 1, 2, or 3 or more trades are the key components to its success. And risk management must be very, very secure for the strategy to work effectively. So what I'd like to do is just walk you through some examples here in terms of implementing a scaling in strategy to your trading portfolio. Now we have the S&P 500 here, and I've chosen this as an example just to show you a very, very strong structured trend moving to the upside. Again, the first trade you'll initially place perhaps is a long entry. Okay, so you're looking to capture the trend. Perhaps you've based it off some very simple Japanese candlestick structures. Again, what we'll do is simply analyze this together. So let's say we see this as a rejection candle and we buy this candle while the market trades up. We're now long the market again, and as it continues to trade up and open up here, it rolls over, and then the trend structure continues to trend to the upside. So when you're at nominal levels here where you feel there's good profit on the table, it's often a temptation for traders to forget their analysis. Perhaps they believed in a long-term growth story for this market, and perhaps wanted to trade the market for a longer period than several days. If that's the case, of course, you should allow yourself the opportunity to actually earn more money from a particular trade. Okay, now this market does continue to trade up. Again, the question I would like to pose here, is this the place, given your entry, where you'd like to take profit at, just given how the market's trading? Another way to phrase this is, would you like to get long this price again? Because if that's the case, why should you be exiting or looking to exit a trade on profit if you'd be effectively looking to take another long position at that price? So what you can do in terms of technical trading strategy, looking at the price action and trying to gain some exposure to the same trade, is actually look to purchase. In this example, we're buying the trend to take another long position. So the first thing we do is enter the market, of course. Then we place our stop loss. As the market continues to trade up to the upside, we can perhaps look to take another second entry in the same market. Okay, now the market inevitably continues to trade to the upside, so it looks like we've caught a fantastic trade. But if you have noticed here, one thing the trader hasn't actually done, we've taken a second entry, but we haven't executed our stop loss. Here's SL2. It should be anywhere around here. Now that's very important to do because, of course, we have taken more exposure in this trade. If the market looks to roll over to the downside and we don't have these stop losses, we're actually in a losing position in around these prices. So there's one point I'd really like to point out here, that if we take an entry, let's say here at 0.05, and again the same entry at this price at 0.05, but effectively we have an overall exposure in this trade of a 0.1, okay, or a mini lot to this trade. That's our overall exposure as the market continues to trade up. But where is our risk in this trade? We have risk set at stop loss number 1 for our first entry, but effectively our average price in this trade is effectively the mid price. Given we've taken the same trade size, our average price is roughly around this mid center here. So effectively, if we're looking to mitigate risk on the trade like we did for the first entry, we should either be moving all stop losses up to maybe a break-even position, or again, if you want to gain that exposure, perhaps the stop loss for SL1 is minus 20 euros. You can, of course, then choose a price just below this here, which will equate to the overall risk that you took on the initial trade. So you're allowing yourself to gain some more exposure in the same trade whilst mitigating the risk on the trade. It's very, very important to do that. And what I want to just discuss in terms of this same market here is effectively the importance of that in really putting your risk, putting the trade, the overall trend at risk. If you were to enter this price here, let's say at entry 3, okay, where effectively is our average price? Again, we're taking, let's assume we take the same trade size of 0.05. Effectively, we have a lot of exposure in this market, 0.15 for the 3 trades, okay? So effectively, as the market trades up, we're making much more money. We're making profit from entry 1, profit from entry 2, and now profit from entry 3 as the market moves up. But again, risk needs to be mitigated off the trade, just given the amount of exposure on this particular trade. You can, of course, look to simply mitigate risk here by bringing entry 1 into a break even around these prices, or you could verify with your average price, which would be around the center point with these 3 entries again, and take your overall risk up to break entry in around here. So you're effectively allowing yourself to push the market, to make as much money from a particular trend as possible through that scaling in effect, so that you're not, let's say, taking your first entry at 0.15, too much exposure for your account, of course, but as the market moves with you, you're gaining that exposure as it's confirming that you're correct in your trade decision, and the market's willing to pay you for that decision. But again, the key importance, guys, is to look to mitigate risk. Now, this is the S&P. We've looked at buying the trend. Of course, one thing I would like to point out just for this particular trading strategy is, of course, volatility. It's very, very important to understand the volatility in that market you're looking to trade, because some markets, of course, are not the best market conditions to scale into. So the question I'd like to pose here, with this price action chart here, we have the gold market in front, is this the best market to scale into? What do we think, guys? Again, totally observable in terms of the reference points to where you look to enter the market. And that's why I suggested at the start, your entry points and your trade size need to be so accurate for scaling in, particularly when you're trading those more volatile markets. Again, you could see if you were to sell the market here and then look to sell the market here, again with S2, your average price would be around here. And if the market pulls back, you're overly exposed to that trade position. As we move across to other candlesticks, again, if you were to sell the market in around these prices, let's say with a short position 1, and then sell around here, you're effectively looking to sell the low here. Unfortunately, with this candlestick, your average price is around the middle, so you have to look to mitigate risk on this trade so you're not overexposing the over position on the trade. So to do bear that in mind, that some markets, if you have a well-defined trend in terms of trying to scale into a market, it's easier to do for those trends and much more difficult to do for those volatile markets. Again, trying to gain a level of exposure, allowing the markets to perform. If they're performing well for you, you can, of course, gain that exposure, but there's simply no point to look to scale in and purchase a market or take the same position in the market 3, 4, 5 times when the market isn't trading the way you want it to. Let's say, for example, we take a short position here at S1, again here at S2, and again here at S3. And as the market pulls back, we just avoid this volatility. Again here at S4. That would be a good trade, of course, but we do need to be aware of these pullbacks and look to mitigate risk just so the market doesn't pull back too much, because effectively we can gain too much exposure on one particular trade, and that volatility can really cause us adverse effects in terms of our account and can cause grave losers if we don't, of course, mitigate that risk. So that brings us to the end of a quick discussion there of today's daily education, discussing scaling in as a trading strategy. Thank you very much for joining us here at Forex Academy. We'll see you next time. Bye for now.